Hey everybody, Max Convexity here. Thanks for tuning into my channel. Not a very good day in the markets today. Let's talk about them for just a second. All right, let's start with SPX, which is what the JEPY trades. As you can see, this was the strongest one of the bunch, and they rallied up and, almost got to the profit box, but then they turned around and sold off. Money-wise, these guys sold their options for 10 bucks, but then they went 40 points in the money and they had to buy them back for 40 points. So they were going for 221,000, lost nearly 700,000. That's the third loss in a row. Yeah, not a great day. Let's look at QQQY. QQQY, they sold their options for 63 bucks, but then their options went 200 points in the money, so they had to buy them back for 200 points. The only good thing you can say about QQQY is they didn't do as bad as they did yesterday. Yesterday, they had to buy their options back for 326 points. That was a total ass kicking for sure. Let's look at IWMY. Same story. IWMY is definitely the weakest of the bunch. They were going for 500,000, ended up losing almost 2.5 million. So let's look at IWMY. All right, IWMY. So if you look here on the chart, I want to talk a little bit of technical analysis real quick. And you guys, I'm going to put a link to Mike, the Tactical Stock Scalper, because he covers this more in depth. But I just want to make a few remarks on the technical analysis. If you guys aren't interested in this, that'd be a good place to tune out. It was a bad day, and that's all we need to know. All three funds lost. But I wanted to give a bullish case on this market. All right, between this day and this day, that's the 23rd, and then the day after whenever the market opened up again after Christmas, which was this was the 13th, and then this was the 14th. Anyway, that a gap is whenever the market has an area where it doesn't trade there. Now, futures traded overnight, and the futures traded through there, but this is called the real-time hours, so RTH. That's an RTH gap. Traders pay attention to those. There's a theory that all gaps are retested, and that a gap is a good place. Let's say you're a bull. If you're a bull and you didn't want to get on up here because get in up here because it's too high, this would be your first logical place that if it gets retested that you might want to put on a bullish trade. And I'm not saying with the Defiance funds at all. The Defiance funds are not meant for timing the market. But I'm just saying the Defiance funds, they exist inside the infrastructure and the ecosystem of the market. They do better when the market goes up. Or they even do good when the market goes down slowly. They just don't do great when the market craters. But nothing does great when it craters. But the bullish case on this is, okay, we went too far too fast. The market just wants to retest this gap, and this would be the first place where bulls might try to make a stand, and bullish traders might make a stand. So then there's another theory about retesting the area of a breakout. A breakout is where you have an area of congestion, and this was an area of congestion where it went sideways for 5 or 6 days, and then it broke out. So and also, if you look at this breakout, it's right around 1900. So that's also an even number. And there's a market psychology theory about even numbers, that even numbers are sticky, or they're also places that traders look to maybe put on trades or adjust their position. If you look back even further, this thing has been on such a bull run, there was another area of congestion right here, and then it broke out. I mean, it's even possible they could come back to here, retest it, turn around and go up, and we're still in a healthy bull market. And I'll give you one more theory. There's another theory about a half retracement. If you look here, the low was October 27th. It was 1633. The high was 2070. So if you look at a half retracement, you take the difference from that, and I haven't done it, but let's just say looks to me like it's right about here. Anyway, that's another area of interest that traders might want to get back on board. But I always like to give both sides of the coin. So if you're a bearish trader, and this doesn't have anything to do with Defiance. If you're a bearish trader, though, Let's say the market rallies back up into this gap. This is a pretty good sized gap between yesterday's action and today's action. Let's say the market rallies up into this area tomorrow morning, and then it falters. That might be an area where a bear might want to adjust his position and put on a bearish trade, and then he's going to hope for a continuation to the downside. Like I say, the defined funds aren't for timing the market, and the market is a big ecosystem. It's not just about people timing the market, but that is a factor in it. There are people that try to do that. There's also what's called passive flows in the market. Passive flows are whenever everyone gets their paycheck at the end of the week, their money goes into a 401k. That money comes into the market automatically. That's one reason why the market goes up more than it goes down over time, because there's a lot of participants in the market that just put their money in blindly and automatically, and that causes the kind of gentle drift up. So you have to look at all things, and you have to look at what the traders are doing or might be thinking about, but then you always have to remember that the passive flows will usually bail you out. So that's my theory on it. I'm going to put a link to Mike the Tactical Stock Scalper's site on my comment section, and I highly encourage you guys to go check it out for a more thorough explanation of what the market's doing if you're interested. All right, guys. Thank you very much, and you have a great day.